as we wrap up the EIA show, we always like to go through what is happening in the U.S., what is happening in the international markets, and how are they going to continue to, again, work together, because what we're talking about when we look at hydrocarbons, they're very flexible, especially the ones we're talking about. Obviously, LNG is frozen, so when you're taking a gas to a liquid, so this is that you can still do it. It's just more costly versus what we're talking about, where there's more flexibility and longevity in terms of the cost of leaving it in storage versus LNG. So these are things that we always like to look at, because it's how do they interact? Where is there an oversupply? Where is there an undersupply? And what price is going to be used to close that gap and create that arbitrage? So when we look at global supply demand, again, this is the update from OPEC. You can see that they expect less declines in December and November versus previous, and we have builds happening throughout 2022. This is pretty stable. Everybody has this. I've had it since June in terms of where things were going, so you're starting to see a little bit of catch up now, just given demand coming down a bit, supply fairly in line with where expectations were, but the delta is always going to be demand. And demand is that's where everybody can have a very heated and a very good debate on where is demand, because everyone has their numbers, their triggers, their high frequency data points, their lagging data points, leading indicators, economic indicators. So no one is really wrong, because you can't even really hone in on what exactly was that demand. The easiest point is to look at what are refiners and what are petchem doing, because that is obviously your biggest buyers. So here's where some of this has shifted. And again, this is not surprising. So I think that's why a lot of this really should have been baked in when you think about where the front month is, as the front month comes down about $2. And the reason why is, again, you had a huge momentum shift, especially when you had Cushing drawing. Now you have some algos that are reacting to the Cushing build, the wild small. This is kind of showing you how the swings can be overextended both up and down. And as we were saying on the last few shows, that the swing just was wildly too high on the front end, which is why we were saying that, going short front month December, going long 2022 December made the most sense in terms of that collapse. But here we are. So then when we look at some near-term stuff, oil companies lodged $191.7 million in high bids for drilling rights in the Gulf of Mexico on Wednesday. The auction brought in a bigger haul than all but two previous Gulf of Mexico oil lease sales, which were conducted under the former President Donald Trump. And when you look at it, 33 companies participated, lodging 317 bids for 308 Gulf tracts. Excuse me. So just showing you how price increases, especially when you look at the price increases across the curve, guys are looking to reinvest and try to build up and get some of the longer term crude, because there is still a lot of oil and a lot of opportunity in the Gulf of Mexico. Now, when we look at product exports, gasoline dipped by 2,000 barrels a day. Still fairly in line, and as we were saying, we expected it to marry with where the 5-year average is. We don't expect that to adjust all too much. Distillate actually had a big drop of 390,000 barrels a day, which is a huge reversal from where it was. We were expecting it to be fairly in line with the 5-year average. Instead, it's 346,000 barrels a day below the 5-year average. We thought the swing up was too much, so this is kind of that makeup, because some of that was pulled forward. We think that there will be a spike and there will just be a normalization. It'll still be below the 5-year average, but again, just moving back up, because this was a bit of a makeup number given how large last week's was. Propane dipped a bit by 190,000 barrels a day. That's still 318,000 above the 5-year average. And again, just as we've been saying, we expect it to remain well above the 5-year average. Then you look at crude oil exports, had a big spike of 573,000 barrels a day, from 3 million to 3.6 million. That'll come down, but as we've been talking about, there's been a fairly sizable shift on the amount of crude going from the U.S. into Europe. That's just being pulled back up again. Europe's crude imports from the U.S. Gulf are set to rise to a 5-month high. In November, 23 tankers carrying about 15 million barrels of oil have already arrived in Europe so far this month. Another 27 tankers hauling 18.8 million are expected to arrive by the end of November. Total volume for November is expected to be at about 33.8 million barrels a day, or 1.13 million, the highest since June, and compared to about 1.05 million in October. So where we were saying we expected to be between that 2.6 and 2.8, this increase of about 100,000 barrels a day will shift that up a bit. We'll probably get a little bit closer to that average, about 2.9 at this point in time. And it's just going to be the exports are going to increase in December. And that's, again, marrying and trying to manage what the storage looks like in Pad 3. Get some of the light sweet crude out, bring some of that heavy sour, medium sweet in through imports. So increase exports, increase imports, try to balance that out, just because, again, that tax man shows up in December, and Pad 3 is going to look to manage their liquids exposure, because they don't want to pay, obviously, excessive taxes, as oil still remains well above the 5-year average. We'll see that drop closer to where we were in 2019, 2016, and they're going to try to manage that, take that crude, export the light sweet, import the heavier slate, make that healthy cut of distillate and gasoline, try to get it onto Colonial, into Pad 1, and again, trying to balance that over time. The spreads have tightened up a bit, where now we're only $4.45 below Dubai. Still a huge discount, but just not as extreme as it was. Starting to see that come back, especially as the front month weakens and things stay fairly flat in the Middle East. Even though we're seeing additional barrels of oil available, they kept OSPs elevated, which again is helping some of that balance out over this time period. And the same is happening in Brent. Fortes, it continues to increase of availability. We have Norway back to about 1.7 million barrels a day of loading schedule. So there's an increase in the amount of crude that is either sitting on the water or expected to be loaded, which is increasing some of that discount, but again, still elevated given where we have been versus the going back through 2016. So still some competition, but again, things are loosening up just a bit. Indian oil just purchased about 2 million barrels of Nigerian crude going through December. So again, still below what was expected, but starting to see a little bit more movement from West Africa into India, and that's for January loading, which is going to be an important thing to watch to see how does December close and January really begin. Then when we look at gasoline exports, as we were saying, we expect it just to be right on the 5-year average. So we should see a little bit of a spike. Again, the timing of that move can alter, because you can see there's a spike up, then a spike down. We could go flat one more week, and then that spike up. But we do expect to see some of that normalcy against the 5-year average. Here's where we had a huge drop in diesel exports, disti exports. We were expecting it to be just below the 5-year average, so come down, but still remain at the low end of that cloud. Instead, it dropped straight through. But when you look at next week, when you look at what has happened over the extremes, the drop that happened this week normally happens next week. So it just could be a matter of timing. So we do expect that increase still be below the 5-year average, but again, still move back within the top end, the low end of that cloud. And then ethane exports have dipped down, but again, still remaining elevated. So when you look at just where things are, again, ethane exports will still remain strong and still be very aggressive across the board as we get this slow increase in crude oil exports, which again will come back down, but still remain within that cloud and not make this new average. Typically, we see a drop and then a spike. Instead, we had that spike now, so we do expect that drop, but closer now to 2.8, 2.9, not as far down to that 2.6 as we've seen previously. So when you look at where that pulls us up to, we're now at about 3.1 million barrels a day on the 4-week rolling average. We think that'll average it down a bit, a little bit more to about 2.9, but again, still remaining elevated into year end. Now, when we look at propylene exports, you can see that it's dipped off the 2021 highs, but still seasonally adjusted all-time high, still at the high end even for 2021. And we'll see that slow a bit, but still remain elevated, just given where pricing is, where demand is, and how that flow will continue. Crude total tank stocks dipped a bit. Still above the low point from 2021. But as we were saying, we expect this to flatline. Now we have more crude heading in from the U.S., which will send this up a bit. But again, just gradual, nothing crazy, still remaining well below that 7-year average. Now, when we look at what has happened on the storage side, looking at products, you can see that there was a small draw pretty much across the board. Gas oil imports are still elevated, but it's just a matter of that timing. So this will come back up, but again, not getting anywhere near the 15-year, that's that 7-year average, but maybe again starting to flatline, starting to tail back up and get to the higher point that we had at the beginning of October. Still just seeing that pressure remaining in the system as gas oil demand still remains strong in the region, and still again trying to manage some of those processes in Europe. Gasoline inventory is still above the 7-year average. Again, that's going to the 13-year average. That's going to remain the case. The arbitrage is fairly close right now, and it's just going to be a matter of how much demand do we see in Europe as cases increase a bit. We expect to see a little bit of a slowdown in demand. But given where refiners are, we don't expect anything. We expect gasoline inventories to essentially go flat. And if things start to increase a bit, then you'll see the ARB open, and they'll take, if this starts to trend higher, that'll then signal that we'll get more gasoline exports from Europe into Pad 1 in the U.S. Then when we look at ARA fuel oil inventory starting to creep higher, again, the arbitrage remains open, but you're starting to see an increase in fuel oil in Fujairah. So it's just a matter of timing as to when someone does that pass through. We do expect more of this fuel oil to get pushed into Asia as the ARB remains open. Now, on the Singapore side, we had another nice size draw of just over 1.5 million. It was driven pretty much across the board, with the biggest being coming down from residual. So here you can see we're right at the 15-year average. And as we were saying, we expected it to come down and then really kind of spike back up. It's just going to go sideways at this point. The timing of when this is being released is the biggest issue. You've had a decent amount of demand open back up into both India, Pakistan, and some other ASEAN nations. That demand has now been filled in the near term. So that's just going to, again, put some of this back in storage. And then as that demand comes back, then you'll start to see this waffle back and forth, which is why we have this basic pattern going sideways. The biggest issue right now is smog. There's been restrictions issued pretty much across large parts of India and Pakistan at the moment, which has resulted in a cut in coal consumption, and that it will also result in a cut in some of that fuel oil and diesel consumption, just given air quality. So that's going to mitigate some of that demand, which will show up in some of the storage over the next 2 to 3 weeks. Just looking at the light distillate had a nice drop, and there was some of that additional pull for gasoline into Central Asia and Southeast Asia, and that's where we thought it was going to go stay above that 15-year average. Instead, it dropped just below. We do expect a hard bounce higher, but just back to the lows that we saw in October, not the highs that we saw in the middle of October, and then continue to see some of this sideways movement as middle distillate continued to drain lower, which is a positive if you could consider where some of the movements are. We're starting to see that build back up. It's just a matter of how quickly is it turned around and sold. And so far, you can see it's been selling fairly quickly. We do expect this to remain below the 15-year average, but just at a fairly tighter range as it starts to curl back up. But again, still within that bullish backdrop. As resid pulled back slightly, this is where, again, that high sulfur fuel oil is where we see some of that competition. This will remain elevated and above the 15-year average, but still remain in a fairly tight range as we go through the remainder of the year. Now, when we turn to sales, you can see Angola has already listed their January sales. And this is, again, the first time in recent memory that I have going back 15 plus years that Angola still has November cargoes available so typically they sell out prior to the start of the loading month. So November is fully sold out by week 3 of October at the latest. And right now we're on November 17th, and there's at least 2 and as much as 5 cargoes still available in Angola. So we do expect to see price discounts because they will want to move some of that cargo. And that's keeping the West African floating storage elevated as they struggle to move it. And it just shows that so far we have not seen China really increase their buying at this point. Imports were at a 39-month low last month. And so far we have them still at a fairly low level, above where they were last month. But they're also not exporting a whole lot of product. They're exporting a bit of gasoline, but really nothing on the diesel side. So that's, again, they're consuming all of that crude, and they're not looking to export as they try to prepare for winter. When you look at Norway here, you can see that bounce from 1.5 up to 1.7, reaching a new seasonally adjusted record, coming right back to some of the strong points and the highest that they've been at in over 10 years. Nigeria, they just kicked a cargo out of November into December as we got a deferral. And then when you look at the North Sea, things are fairly stable. Libya had a nice bounce in November after bringing some of those, I should say, bridging some of the issues that they've had on the political side. So they're expecting 1.127 coming out in November, and we expect about 1.1 in December at this point. As Russia has a little bit more to go, they should get to about 3.9 in November, and we're expecting them to get closer to about 4 million in December. So now when we look at pricing, Angola had some pricing soften. So when you look at December loadings, recently traded at about $1 versus dated Brent, which is about $1.50 off of where it was currently. The IOC buys the Indian Oil Company bought 4 million barrels of West African crude for January loading via tender. Vital and Glencore sold 2 million barrels each in the tender. So Nigeria deferred a cargo into December, as we were talking about. And then when we look at Gunvor, sold 100,000 tons of Urals at for delivery in November 4th to December, from November 30th to December 4th. Delivery at dated Brent minus $1.45. It last traded at minus $2 about 7 days ago. So you see how it's sitting between that minus $1.40 to minus $2. It's just a matter of where some of that demand is. Withdrew a bid for some Siberian Light. ESPO crossed a little bit below where it has been. It still was at $5.90 to $6.10 premium, but previously it was trading closer to $6.30 to $6.90. So you're starting to see that soften up just a touch, but still very strong in terms of where that demand is. And then when you look at Qatar sold 3 cargoes of crude for January loading at an average premium of $3.40 to $3.50 a barrel to Dubai benchmark. That's higher than last month, which was at $2.45 versus $2.50. So you're still seeing some of that demand from the Middle East. BP sold Fortes Glencore to Glencore for December 9th, 13th, dated $1.50, plus $1.50. Glencore also sold Fortes at a dated 70 cents and December 9th through 13th loading at $1.15 FOB. So fairly stable, nothing too much up or down. If anything, there's a little bit of softness, but again, still seeing things fairly stable when you look at that underlying pricing. So again, just showing that things are starting to move along. We expect to see some of these additional discounts come into West Africa, especially with Nigeria, Congo, and Angola all sitting with a lot of cargoes still available in November. So now when we turn to inventories, excuse me, we were expecting a little bit of a drop in Fujairah. Instead, we had a sizable build in the region. So total oil products were reported to come in at 20.296 million barrels. First time total stocks were reported above 20 million since July 26th. So when you think about the total stocks rose 446,000 barrels, the total stock was really driven with an increase in light distillates and heavy resid, while middle distillates had a small draw. Light distillates, including gasoline, rose 168,000 barrels or 3%. Traders said that they do expect to see demand for prompt Asian gasoline to stay supported until at least the first half of December, given, again, as things reactivated, you had this big slug of product going through. But given how things have drawn down from Singapore, again, this is mitigating some of the demand that needs to come from Fujairah, which is why we're not seeing huge draws or huge builds. It's just kind of stabilizing at this point. We expect that to continue. Middle distillate, including diesel and jet fuel, fell 102,000 barrels coming in. This is a reversal of last week's 339,000 barrel build. Markets, they still see that China is really not increasing, and planned partial lockdowns in Europe are starting to offset some of that. Gas oil fundamentals still remain fairly supported in Southeast Asia, but things are starting to see some headwinds in Europe with some of the increases in COVID. So again, just kind of that balancing act. We expect to see just a little bit of an increase, but still middle distillate remaining in a bullish backdrop. Heavy resid rose 380,000 barrels back to 10.881 million. Modest continuation of last week's rise of 3.115 million. Spot trading activity at the major bunker hubs for Fujairah and Singapore have cooled since November 16th. Again, there was some demand, and then it really kind of pared back. Flat pricing continues to make things a bit complicated, and you're just not seeing a lot of demand for that gas to oil switching, and you're really not seeing too much of an increase in the demand into shipping. Crude oil in the water, seasonally adjusted all-time high, and then the highest level it's been at since 2020 in 2021. There's just, again, that's because there's so much crude that still sits on the water and floating storage, and you're starting to see this acceleration of exports. And that's because, again, we have more crude available for export as we're in November 17th. You have the Middle Eastern countries that have increased their exports, given they've increased production. But again, there's production and then there's exports, and exports continue to go higher out of Russia, out of the Middle East. And then when you marry that with the amount of available cargoes in the floating storage market, that's where we continue to see the amount of crude oil on the water continues to drive higher. Oil in transit spiking to the highs, just based on what we're seeing. It won't maintain this pace, but we'll still maintain this level. And the question is, when does it show up at the coast? When does it get converted from oil in transit to oil in storage? And that's going to be those timing delays that we've been talking about and that we continue to see when we look at crude going into transit, getting pulled out of floating storage, and then getting replaced back into floating storage. Because if it comes from floating storage in West Africa, then it goes into transit, and then it becomes floating storage somewhere else, and then it gets moved into the system, which is why we try to look at that full supply chain of not only just land storage, but also the offshore market. Here you can see that floating storage dipped a bit, and again, it's converting from one to the other. We're still fairly tight. We're now below where we were in 2016, just because remember 2016 we had that renewed, that mini fight, if you will, between Saudi and some of the other nations, and that also we were having some pretty sizable slowdowns, and then you had a lot of stimulus coming from China at the back end of 16. But that's where, again, we just expect it to be pretty much here through the end of the year. We don't expect it to go up or down all that much on average, because it'll come down and then it'll spike back up and then it'll come back down. It's just going to be a matter of when does that crude in transit show up and how quickly does it get moved into onshore storage. Time spreads have come down a bit. They're fairly firm at about $1 in the Brent time spread on Jan-Feb. We don't see that adjusting all that much as we go through. If anything, it should come down further and closer to that 80-cent range. But again, we've still been seeing some fairly weird moves in the spread side. State-owned refiners in China have bounced back a bit, still below where they normally are this time of year, but you're starting to see them get back to some of this normalcy as Shandong Independent or teapots actually slowed. Still above 2019 levels, just below where they were in 2020, and I would expect to see teapot activity kind of flatline here as the state-owned guys ramp up a touch. Here's the spread between WTI December versus December. You can see it hit $12 and it's now back to about $9. I would expect that to continue to fall just as really this December comes down and you just have some pretty much a stable December 22. And I think you get some of this flatlining when you look at the underlying curve, which as we showed in segment 1, you're really starting to see. Singapore refinery cracks have stabilized here. Still not, that's not a good thing. That's not a bad thing. It's just, they're just kind of here. The fall in crude pricing will help, but again, the elevated OSPs are a problem as well as their input costs. So they're still just around 0 to negative. So again, still something to watch as you look at Singapore activity and just moving fairly close on the hydrocracking side along the 5-year average. But when you think about and then factor in input costs, it's actually a bit lower. So it's still something, still positive on a hydrocracking side, but just giving you an idea of kind of where some of the struggle still remains on underlying demand. Northwest Europe flatlined a bit for the heavier side. On the lighter side, things have weakened a touch, and that's carrying out just in terms of where things are for gas oil and fuel oil versus where things are for gasoline and the lighter end, where you're not seeing the same type of demand nor backdrop. And then when you look at something very similar, when you look at topping, when you look at hydroskimming, still firmly negative as the heavier side still remains elevated on the gas oil and the disti side. So we'll still see some of those movements. Again, costs still remain elevated, and this is where we should see more medium sweet. And we're just not seeing it. Instead, it looks like they're willing to splash blend a bit more, which is taking Urals and just hitting it with U.S. crude and not using as much from West Africa, because typically West Africa will clear into Europe, but we're not seeing it clear. Well, I should say Nigeria, because the others typically clear into Asia, and we're just not seeing that clearing mechanism. And instead, we're seeing some segments come in out of Asia, trying to pick up some different cargoes. We had 2 Angolan cargoes clear into the Atlantic Basin. Still more to go, and I think you're going to see some of those discounts as that panic starts to increase and wanting to maintain some semblance of normalcy on the floating storage side. Supertanker crude imports fairly flat. We expect this to creep higher to closer to that 3-year average, but again, just a matter of pricing and timing. When we look at Asian floating storage, still well off the lows from 2021. We just expect this again to go sideways, come down a bit, and then go back up as that crude shows up and then sits offshore as they wait for clearance into the underlying storage levels. North Sea, you had some of those additional sales. So again, you've had some movements go from floating storage into motion. You've had a little bit of an additional import into Europe. But North Sea loadings are increasing, so they have an incentive to clear some of this. We just expect it to be very close to, again, that 5-year average. West Africa surging back to a 2021 high. We just expect it to stay at these elevated levels as they still struggle to sell November. They did sell 2. Again, it's still not there. So it could come back down, but again, not coming back within this cloud, still remaining at this all-time high level. Then when we look at Middle East, again, creeping higher, still at the high end for the last couple of months. And as more crude comes to market, given the increase in production based on the OPEC agreement, we expect this to continue to grind up. And this is the tell for kind of how heavy can the market be. And as this continues to creep to the higher end, obviously 2016 was that super elevated level based on some of the fights that we had in between the different entities. This, again, is just going to trend back up and just fall within this elevated level as more crude gets stuck on the water trying to clear, especially with an increase in OSP prices. So far, they've been allocating fairly normal allocations to their term buyers, but nobody is picking up spot, which again is going to leave some of this, and we expect this to creep higher and set that fairly new record outside of 2016. Europe back down to the 5-year average. We expect this to, again, just remain sideways at this point as we do have more product coming from the U.S. Crude on the within China's Shandong falls back to where they were in 2019. We expect this to again remain fairly stable versus 2019 levels. But what are they doing with it? Well, they're turning it into product as fuel oil goes back to the highs of 2021, as China prepares and makes sure that they have enough fuel oil and diesel for the winter. So turning that crude, taking that out of crude, turning it from crude into product. So when you look at the balancing act right now, they're fairly flat as one becomes the other as they look to prepare for winter. If you have any questions, again, you can find us on the comment section on Twitter. We always appreciate hearing from you. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.